want to bring in our next guest. I mean, the Fed's action certainly is moving stocks. You're seeing that across the globe. There is a big stock market sell-off happening right now. Nick Sargen is at Fort Washington Advisors. He's skeptical that the Fed's move will support the economy. Never mind the stock market. That's not the Fed's role. Nick is Chief Investment Officer at Fort Washington. He oversees about $36 billion in assets. He is joining us from Cincinnati. Nick, thanks for being with us this morning. What did you dislike the most about what the Fed did or said yesterday?
Well, actually, I thought what the Fed said was so well telegraphed. Everybody, was saying we would see this Operation Twist. And if anything, they gave you an extra $100 billion. But, the prevailing view, and certainly my view, was not to expect another round of quantitative easing. So the difference, of course, is in quantitative easing, they would have increased the size of the balance sheet. And so, given that I thought that news was priced into the market, I wasn't expecting a big reaction. And so my surprise is the market's reaction. And first, the magnitude of the decline in the long-term yield. And as your previous commentators have said, I think you can explain some of that. But really, we had a very quiet day in the market, as you know, yesterday. And then all of a sudden the announcement comes, and then the stock market just falls out of bed, and it's continuing globally and the like. So the only conclusion I come up with to make any sense of this is that some people were still clinging to hopes for a Hail Mary of a bigger quantitative easing, which obviously did well for the stock market on round one and round two. So that, I think, was the disappointment in the stock market. But why people believe that, I have no reason to explain.
Well, does that mean, Nick, that this is essentially a short squeeze, that people don't think the Fed is going to do anything more and they're getting out now?
Well, I think again, when we saw the market rallying off the lows in the second half of August, remember during that period, I mean, the news was coming in very, very bad. And, but you'd still read that, well, maybe the Fed will do QE3. And, again, at that time, I just wasn't holding out any hopes that was going to happen. But even that expectation was taking us higher. So I think it's a little bit, as you're indicating, that now you've taken the air out of the balloon. And I guess the one point I would make is, does this mean that they will not do quantitative easing 3 ever? No. I think what the Fed is doing is two things. One, they really, they had 3 dissenting votes again, so not everybody's on board. And the principal reason is that when they did quantitative 2, remember the inflation rate was much lower, and the fear was deflation. And so now you have inflation for core at 2% and for headline well above 3. So I believe that to do quantitative easing 3, you have to wait for evidence that inflation is really coming down again. And I think that will take a while.
Well, Nick, given the point that you just made, the outlook for inflation, can you see, absent QE3, yields going down any further from where they are now? The 10 years at 181, the 30 is at 291.
Excellent question. I never thought I would, or if you did, go back to the worst of the financial crisis when you got yields down, about this low or whatever. Even then, we'd say, well, this is temporary. So what's changed? And this is, I'm also a bond investor. What a tough environment, because we're seeing things we never thought we would see. But think of this. The Fed has told us they're not raising short rates for a minimum of 2 years, until mid-2013 at the earliest. Then tack on to that Operation Twist, where they're saying, now I'm going after long-term yields. So that's why I think the message for us as bond managers is get used to it. We all have sticker shock. And I'm not saying that yields can't go up from current levels. Don't get me wrong, because I think this may be a bit of an overreaction. But what I am saying is, I think for the next couple of years, I've got to manage bond portfolios where Treasury yields could be very, very, very low.
Very low. And Nick, just out of curiosity, I mean, we know that the Fed is becoming more and more concerned about the mortgage market. Do you see the move yesterday as going to have any real meaningful effects?
Unfortunately not. I mean, clearly, why did they want to bring long-term rates down? Because they thought those are more critical for mortgages and also for business investment. But as we all know, the problem isn't how high mortgage rates are. With mortgage rates and lower home prices today, this is the best affordability for Americans in 4 decades. And yet, even with that, we've seen the miserable housing starts and the like. So I think they're doing, I guess I feel for the Fed. Everybody's saying, don't just stand there, do something. So they came up with something. It actually worked. I mean, they should be pleased. They got their objective on the bond market. But I think they've got to be very surprised by the reaction on the stock market, both here and abroad.
Nick, thank you so much. Nick Sargen, Chief Investment Officer at Fort Washington Investment Advisors. You heard him just say the Fed met its goal as far as the bond market reaction goes, but probably is surprised by what's going on in the stock market around the world.